Yesterday's CPI data from the US had a sweet and sour taste, really. It saw a mixed market reaction as well, but gathered investors around the idea that a 50 basis point cut from the Fed won't be on the menu of next week's FOMC meeting. Now today, the European Central Bank will likely deliver another 25 basis point cuts, and officials there could be targeting even more. So welcome. It is Thursday, September 12th, and this is Swissquote's Daily Market Talk. So yesterday's CPI data from the US and the market reaction to that data was quite mixed, really. The good news is that the headline inflation in the US fell from 2.9 to 2.5% in August and sank significantly below the 3% level where it was resisting since last summer. Now, the drop in food and energy prices globally clearly helped easing the pressure in the headline figure. But core inflation, on the other hand, which excludes these volatile food and energy prices, came in line with the expectations on a yearly basis, but slightly higher than expected on a monthly basis, because cost of housing and travel have apparently been responsible for the stickiness in there. And I believe that while the fall in food prices is the continuation of the post-pandemic supply chain improvement story, and that the fall that we see in energy prices is all due to various global geopolitical and economic factors, well, the stickiness that we see in housing prices remains an issue that the Federal Reserve must address itself with its own rate policy. So yesterday's data only came to wave goodbye to the 50 basis point cut hopes from the Fed. The probability of a 50 basis point cut at next week's FOMC meeting crumbled to 13%, bringing the probability of a 100 basis point cut this year down with it. But note that there are still analysts out there, like the ones at Citigroup, for example, who think that the Fed will cut its rates by 125 basis points this year. And the only way it could happen is if we see a sharp economic slowdown, another financial crisis, another health crisis, or aliens landing on Earth. Now, it is not impossible, but it seems highly unlikely at this point in time. Now, looking at the market reaction to yesterday's data, the US 2-year yield rebounded from 3.55% level as Fed those scaled back their jumbo rate cut expectations for the Fed, and the US 10-year yield climbed to 3.66% from 3.60% tested earlier. Equities first slid on moodiness that the Fed would cut less than projected before the CPI data release, then rebounded on optimism that if the Fed cuts less, well, it is because the economy is doing relatively fine. So the S&P 500 ended up the day 1% higher and above its 50-day moving average. Plus, the spread between CPI and PPI is narrowing but remains positive. And a positive spread between the two, between CPI and PPI, is typically associated with a solid operating margin outlook for companies, according to Bloomberg Intelligence Research. So it is still not too bad. Anyway, the Dow Jones and the Russell 2000 indices also closed in the positive territory yesterday's trading session. The technology stocks led gains, leading to a more than 2% jump in the Nasdaq 100 index, while the energy sector in the US remained under pressure, and that despite a rebound that we saw in crude oil prices after Hurricane Francine ran over key oil production zone in the Gulf of Mexico that actually produces around 15 to 17% of the US total oil production, and where oil producers had to shut around 25% of their operations yesterday. But we know that it will take more than just a hurricane or even a war in the Middle East to push these oil prices sustainably higher in the foreseeable future, because the demand concerns are growing right now. OPEC turns cautious, and Citi, goes a step further than that, stating that there is no room for any more barrels in the market right now. They argue that not only should the cartel avoid increasing its production in the coming months, but it must also cut an additional 1 million barrels per day throughout 2025 to balance this market. So you see, the bearish outlook in crude oil remains despite all the short-term rebounds. But we can say that that's not a worry that Nvidia has today. On the contrary, Nvidia's CEO Jensen Huang said yesterday, well, he said that the demand for its advanced chip is so great that the customers are just frustrated if they don't get their chips fast enough. He said, well, everyone wants to be first and everyone wants to be most. Well, those are obviously first world problems. So his words gave a boost to Nvidia yesterday, and the stock rallied more than 8% at yesterday's trading session, defying the AI fatigue, whereas VanEck's semiconductor ETF jumped more than 5% yesterday as well. Elsewhere, Donald Trump's DJT tanked to a fresh low after his mega performance against Kamala Harris at Tuesday's presidential debate, while solar stocks surged yesterday, led by a 15% rally in First Solar on hope that a Harris win would boost the climate-friendly stocks. In the FX markets, while the US dollar jumped yesterday and extended gains in Asia again this morning, the dollar yen rebounded after having tested the 140 waters. Cable flirted with the 1.30 support as growth in Britain stagnated for the second month in a row. And this time around, it was not even the weather's fault, I think, because unusually, I haven't heard anyone, any analyst or any economist blaming rain for July's soft figure. And the euro dollar licked the 110 level to the downside. So the European Central Bank will meet and will most likely deliver its second 25 basis point cut later today. And that's, well, fully baked in the market prices. But what's uncertain is how the European Central Bank sees the future, because the Eurozone economies have been slowing. Germany is having a hard time keeping its head above water. Its iconic Volkswagen announced job cuts recently, remember, so that's been a real punch on many people's face. Then, with all this, the right-wing parties are surging, even in Germany and in France. No one sees the end of the tunnel in the Ukrainian war, unfortunately, and even China is not there to help the zone's luxury brands afloat. So the winter is really coming in Europe. And therefore, some European Central Bank members will be tempted to cut more than the 50 basis point rate cut for this year baked in the market prices, including today's rate cut. But some other members will certainly remain cautious, pointing at the risk of an inflation uptick in the Eurozone. Therefore, Christine Lagarde's post-meeting presser today will decide which direction the Euro take from the actual levels. If Lagarde sounds like she and her colleagues at the European Central Bank remain concerned about inflation risks, then the Eurodollar could actually find support near the 110 psychological level and make another attempt on the 112 level in the coming weeks, perhaps. But if she and her colleagues show any signs of growing concerns about the gloomy economic outlook of the Eurozone, well, it will be just about time and a good reason for the Eurodollar to return below the 110 psychological mark. I personally think that the latest German and French jitters, both on the political and economic front, have the potential to tilt the market expectations toward a series of 25 basis point cuts starting from today, one in October and another one in December. So I have a bearish outlook walking into today's ECB decision and Christine Lagarde's presser. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.